Hey guys, today we'll be talking about Chapter 15, Financial Management. We'll talk about roles and responsibility of financial managers. We'll outline the financial planning process, talk about the three key budgets in the financial plan, and we'll explain why firms need operating funds. We'll also identify and describe different sources of short-term and long-term financing. Right. So what is finance? The finance function is responsible for managing a scarce resource, capital. It's a function in the business that acquires funds for the firm and manages those funds within the firm. So this can include assets, investments, and liabilities that make up the financial system. It also includes money management and can extend to activities such as investing, borrowing, lending, different types of budgets, any types of savings the business has, and forecasting. We'll discuss what forecasting is in the future slides. I like this quote. Finance can be defined as the art and science of managing money. So, why do we have forecasts and budgets? Why do we need savings accounts? Why do we need to estimate the costs that we're going to incur during regular operations? Well, so we can avoid scenarios like the one pictured. This company is providing construction work and contracting out to a customer. If they all of a sudden can't afford fuel for their trucks, what happens to the company? What happens to its operations? What happens to its strategic partnerships? And will the customer have confidence in them in the future if they're not able to perform day-to-day operations such as moving the vehicles on the premises? So financial management is the job of managing for the firm's resources to meet its goals and objectives. So what kind of goals or objectives are we looking for? This can start from the very beginning, from obtaining financing or funds to start the business, to controlling funds to expand the business or expand its reach or locations or adding a website, and also controlling the use of those funds during the company operations. One important thing to note is that financial managers need to understand accounting. In fact, many of them have accounting backgrounds, but they're not accountants. They use the information generated from accounting to make strategic decisions within the company. So, what type of careers could you possibly have a future in if you were interested in finance? Investment banking is one of the largest areas, but it requires you to start immediately out of college. It also requires extremely good grades in college and internships or partnerships with companies upon graduation. So, if you were interested in investment banking, it's something that you would have to start early. Asset management includes inventory management, accounting, auditing, and sorry, waiting for the motor to stop outside. And asset management also includes reconciliations. So, some other positions are commercial banking, equity research, corporate finance, and risk management is definitely a growing field, both with the concerns from cybersecurity attacks and from the varying climate of the global industry. So this slide mentions signs that you need a CFO. These are not entirely exclusive to the CFO role, but they're definitely part of the full function. And when your business starts to grow to the point where these become expand to the point where they become a problem, then you might need financial leadership, such as a CFO. So you may not have information on key items or forecasts. They might have to have someone dedicated not only to creating the forecast, but identifying how they contribute to the mission and goals of the company. You need to have an individual watching and analyzing expenses. This doesn't just include short-term or just long-term expenses, but those perhaps purchases of assets that will allow the company to grow over the long term. You need to be aware of regulatory changes that are affecting your business. This could be within the accounting function. This could be within reporting or communications functions. You need to be able to generate financial reports and have them monitored on a regular basis. If you're being audited and you don't know what to do, then you'll need a financial leadership function. And if you go IPO and have shareholders, then they might be frustrated with the lack of communications, which would otherwise be provided by a CFO. So, what do financial managers do? They are included in the in audits, both internal and externally. They manage taxes and help reduce the amount of taxes the company needs to pay through understanding what regulations and possible advantages are taking place. They advise top management on financial matters. They also are able to collect funds and oversee credit management, control funds from day-to-day operations, obtain new funds or different types of financing. They are a key part of the budgeting forecast and budgeting controlling functions, and they also aid in planning at all levels of the organization. So what worries do financial managers face? Generally being unprepared from a cash standpoint, being unprepared from an additional debt that might be incurred, from overall operational functioning, everything requires a plan. So if you are the kind of person that loves numbers and loves to understand what is happening everywhere at every moment, a finance career might be in your future. Market unpredictability. This could be from external forces or from decisions or political activity happening within the market segment of the organization. Limited cash flow can quickly become a problem. Interest rates, whether they're rising or falling, will affect strategic decision making within the company. Cyber threats are a concern from a transaction standpoint and also from internal accounting. Financial regulations from the government, which seem to change by the day. Volatility of the dollar and foreign competition. And then environmental regulations, which can impact costs faced by the organization. So, three of the most common reasons a firm fails financially, and this is important for your studying purposes. Um, Number one is undercapitalization. This means not having enough money at the beginning for startup costs or the initial implementation of operations. Companies often ask for a certain amount of cash. They underestimate exactly how much their startup requires to function, and they could die at the get-go or not last very long because of capitalization issues. The second is poor control over cash flow. This is similar and related to undercapitalization, but it's happening over the operational period from month to month. Um, do our startup sales and profitability, are they enough to cover the monthly operations? If not, then the business will not last very long. The third portion is inadequate expense control. This can come in the form of purchasing too much inventory, dedicating too many dollars to marketing purposes, or using expenses for the wrong purposes. Imagine you have a company and five of your employees have company credit cards. What would the limit for their expenditures be? What things would they be authorized to pay for? When would this cutting be, or the spending be cut off in the case that sales numbers are not performing as expected? All right, this slide is taken directly from the textbook, and it highlights Goodwill Industries. Goodwill was barely functioning as a nonprofit organization. They required additional funds and donations in order to keep sales going. Michael Miller came into the company and decided to treat the nonprofit like a for-profit business. He compared sales against each individual store. He would close stores that weren't making enough profit, and he adjusted pricing to reflect the resale industry at the high end. So now sales from Goodwill soared as a result, and they're now making over 135 million, possibly more. That was in 2022 at the time the book was printed, and they no longer need outside funding. So, in financial planning, we have three key steps. The first one is forecasting. Forecasting can mean short term or it can be address long-term financial needs. Forecasting is just like forecasting in weather. We are predicting the future without having absolute certainty of the outcome, but we can predict to some extent based on the information that we have and what we know, developing budgets to meet those needs. So once a forecast has been made, then the budget can be built around the forecast, estimating needs for employees, needs for supplies, anything else surrounding the operations of a given estimate. And three, establishing financial controls to see if the company is achieving its goals. So this could mean mid-month, end of month, periodic audits, or other assessments of financial numbers to see if sales are on par with what is expected, to see if production is meeting demand, and so on. Okay. Figure 15.2 shows financial planning with the financial plan being the start. This comes from the C-suite of the company, the top leaders, and those that are able to make decisions about the direction that the organization is going. So the financial plan can create short-term forecasts and long-term forecasts. Using the plan, we can create a master operating budget. The master puts numbers to the plan. It turns the plan into a detailed financial roadmap for resource allocation. That master budget can be broken out into a capital budget and a cash budget. The capital budget determines what long-term assets can be purchased and how expansion is addressed. The cash budget addresses operating expenses such as employees, supplies, and other day-to-day expenditures. So using this information, we can control the actuals that are in place by by consulting the budget and seeing how the actuals reflect or vary from the budgets. Right. Budgeting is critical for the organization to control expenses and to understand revenue expectations. It sets forth management's expectations and allocates the use of resources throughout the firm. Budgets rely on the three key financial statements, such as balance sheet, the income statement, the statement of cash flows, and possibly other statements with short and long-term financial forecasting. The budget is the guide for financial operations and expected financial needs. Think of it as the difference between where you are and where you can reasonably expect that to be. All right, here I wanted to mention that money has a time value. So, what does that mean? There's an old adage that says a dollar today is worth more than a dollar tomorrow. Now, that means that money loses value over time for a couple of reasons. The first one, as shown in this chart, has the effects of inflation on the dollar over time. You can see that the curve is fairly steep at 2% and increases drastically at higher percentage rates. This means the higher the inflation, the more uh, the relative dollar declines in a faster amount of time. So, time value of money is the financial principle stating that money received now is more valuable than the same amount received in the future. The other reason is for the ability of money to compound or to grow in returns through investment or um, or compound interest over time, which can allow money to increase in value. So if you have a dollar and you do nothing with it, over time it becomes worth less and less. All right. So operating funds are crucial because they manage the day-to-day operations of the business. You need to control the amount of credit that is being paid back in each month and also the amount of inventory needed. This means that you don't want to purchase too much inventory or too little inventory to cover the period that you have sales. So, capital expenditures would be tangible long-term assets, such as buildings, land, equipment, or other intangible assets, such as trademarks, copyrights, or patents, which we had learned last chapter also have value. Right, so we already mentioned that money has time value. Um, Making credit available can help keep customers happy and help attract new ones by using that money to reinvest to hopefully gain more capital in the future. Some ways that we can raise funds would be through selling ownership of the company, or otherwise called equity, or by earning profits due to sales and operational efficiencies in the company. You can produce uh, additional capital through debt financing. This means loans or bonds, or you can use equity financing, which is money raised from within the firm, using ownership of the firm as collateral. Some examples of short-term funds uses would be to cover monthly expenses, to have extra money for unanticipated emergencies, to resolve cash flow issues, or expand current inventory. Perhaps you have a t-shirt that keeps flying off the shelves and you need to purchase a large quantity in order to get ahead of it and to actualize every sale possible. You might need some short-term funding to cover those needs. Temporary promotional programs might need additional cash funds. Some long-term funding projects would be for R&D or new product development, replacing capital equipment such as vehicles or manufacturing equipment or tools that have high expense. Conducting a merger or acquisition would require long-term financing, possibly, or expanding into new markets. New facilities or growth of current facilities or additions would also be long-term uses of funds. So one thing you can never have too much of is cash. As long as there's cash available to meet financial needs, remaining cash can be used to invest in the future of the company. If you're looking for short-term financing, one option might be to use family and friends. Now, I strongly suggest against this option if you have other, other ways available. But if you do choose to accept help from family or friends or give help to family or friends, it's important that you treat it as you would any other loan. Make sure that the terms are spelled out. Make sure that the loan agreement is put in writing and that you guarantee or they guarantee the repayment schedule the same way you would for a bank or a private entity. Getting loans from commercial banks can be a bit of a challenge. They tend to like to loan to larger, more established businesses and give them short-term loans. This guarantees interest and the return of the full principal that is being loaned out. Another thing to consider is that when there are economic downturns, commercial banks may not lend out at all. Some forms of short-term loans could be a secured, an unsecured loan, or a line of credit. Secured loans are backed by collateral. That means they have some physical or tangible value, asset of value that is guaranteed for the loan to go through. For the unsecured loan, it doesn't require any collateral, but it may have a higher rate of interest. A line of credit is a short-term debt that is given to a company provided the funds are readily available to cover the line of credit. So we learned in the last slide that a secured loan is backed by collateral. One example would be a car loan. In the case of a car loan, the car is the collateral, which guarantees payment with or exchanges the asset for lack of payment. In the case of a mortgage, the home is the collateral. Another way to obtain short-term financing is through factoring. Factoring allows companies to sell accounts receivable or monies owed by customers that are relative or highly guaranteed to be transacted in a short amount of time. So market intermediaries will exchange the accounts receivable and give the company cash at a lower percentage than they're guaranteed in order for them to make money and for the company to have a short-term liquidity available. Credit cards. So it's estimated that one half of all small businesses use credit cards to finance their business. This can be pretty scary because interest rates can rise quickly and it can be extremely costly for a small business to operate on credit cards. The protections provided the Credit Card Responsibility Accountability and Disclosure Act are relative to consumers. They do not apply to businesses. Other ways to raise startup capital as a small business would be to join a crowdfunding site. You could seek out microfinancing. You could use asset-based lending or factoring. You could apply to accelerators and incubators. In Austin, there are several. They also have startup competitions where you can pitch your business and then receive a cash reward or a stay with an incubator where they'll help you grow your business. You can sweet talk vendors you want to do business with. This may be in the form of increasing the repayment period or getting discounts for bulk orders. And of course, you can ask family and friends to invest. So, if you are in the event that you're looking for capital and are not able to find it, there may be a couple of reasons why you're not able to secure funding. There might not be a formalized business plan. Um, Even banks, as well as private investors, angel capital investors, um, venture capital firms would all want to see a business plan and understand how you're going to use funds. So you may not know what amount you need from a lender. If you're asking for a blind amount and don't have a source use table, then you will likely automatically be rejected. If you have poor personal credit or the business has poor credit, you're unlikely to receive any kind of capital uh, addition. The company's either overvalued or undervalued, then they're not likely to receive additional capital. And management can be unrealistic about the growth. This could come in the form of overestimating or underestimating costs or the return on the investment. So, in setting long-term financing objectives, financial managers will generally ask three questions. What are the organization's long-term goals and objectives? What funds do we need to achieve the firm's long-term goals and objectives? And what sources of long-term funding, capital, are available and which will best fit our needs? So, in order to receive credit from lenders, they generally use the rule of the five C's. They are checking the character of the borrower. It's essential that lenders make good decisions when deciding whether or not to loan capital to potential borrowers. The borrower needs to have the capacity to repay the loan. The capital being invested in the business by the borrower, they need to know how much capital you are personally putting up. Sometimes you have cash available, sometimes you have savings accounts which are liquidated, or some businesses even take mortgages out on their home in order to have additional capital. But this shows that you have quote unquote skin in the game and are well invested in your company. The conditions of the economy and the firm's industry are also considered by lenders to ensure the payback period and that your company will thrive in current conditions. Lastly, the collateral the borrower has is important to secure the loan. This may mean that the company is built on a property, or you may have manufacturing or equipment or inventory or other means to hold collateral for the company. All right, debt financing. So, debt from lending institutions can include long-term financing, which can be as little as 3 years, but now is extending to 15 or 20 years. Um, and with term loan agreements, loan interest is tax deductible. So companies that offer debt financing consider the risk-return trade-off. This means the higher the risk that the lender is taking, the higher the interest rate that they're going to demand. Another way to get financing is through equity, through selling stocks, which is shares of ownership in the company. So if you have a private company and you want to go IPO or have the initial public offering, this means that you have stocks available to trade as part ownership of the company. You can also get equity financing from venture capital firms. A venture capital firm creates money that is invested in new or emerging companies that are perceived as having great profit potential. So, depending on the firm, different VC firms have different verticals that they're interested in that they might be looking for a company like yours to invest in if they believe that it will guarantee them a high rate of return. This talks about some of the advantages and disadvantages of issuing stock. So, one advantage is stock is being purchased, but it doesn't have to be repaid. There's also no obligation to pay dividends to stockholders. This is based on the performance of the company and at the discretion of the company. The additional profit could be used to reinvest in the business as opposed to paying stockholders an extra dividend. And those um, sorry, those are not tax deductible. So selling stock can improve the condition of the firm's balance sheet potentially. And since it creates no debt, the corporation can buy back its stock to improve the balance sheet. Uh, so some disadvantages. All stockholders have a right to vote for your company and in its board of directors. Adding shares of stock to the company can alter the control of ownership within the firm and the voting rights of those holding stocks. Um, oh, again, dividends are paid from profit after taxes and are also not tax deductible. And keeping stockholders happy can also affect managers' decisions. They may not choose what's best for the company, but rather what's best for the stockholders. So, you've decided to take a risk and open your own business. Um, the example shown in the slide is Dave Denoy, and he cashed out his retirement plan to purchase a franchise for kickboxing. Do you think that this type of financing strategy would be risky? The answer is absolutely yes. He's gambling his ability to retire and potentially a large amount of his future on starting this company. Also, if there was a case of an economic downturn, a gym membership would be one of the first luxuries to go. This means that environmental fluctuations are a high risk for this type of industry. Going back to VCs, if you're interested in attracting one, some of the basic questions that you'll need to have answers for are, can the company grow? And not just grow, but grow exponentially. Does it have the ability to disrupt the current market that it's entering? Are you and your team problem solvers? Is your valuation accurate? Do you make good financial decisions? Have you done research on the VC firm? In other words, do you know that they would have interest in your product or service? What kind of return would the venture capital company that you're requesting money from reasonably expect, given your forecast? And will it be worth their money and effort? That means they're requiring anywhere between a 6x and 40x return on their initial investment. Creating debt through financing is also called leverage. Leverage is raising funds through borrowing to increase the firm's rate of return. The cost of capital is the rate of return a company must earn in order to meet the demands of its lenders and expectations of its equity holders. One way that VCs mitigate the risk involved with investing in companies is by buying several different types of investments or spreading the risk to multiple verticals in order to hedge their investment. So, what is financial leverage? Essentially, you are borrowing or financing money in order to get cash available so you can reinvest that money into the firm, and hopefully, their income will, from that investment, will prove higher yields than the initial amount borrowed. This will allow you to repay the firm, excuse me, repay the initial capital funding and allow you to grow the business and enjoy profits. That's all for chapter 15. Thank you, guys.